Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. Today's agenda, so I will be going through the market update and then we'll have Shawn go through some of the earnings trades. One thing for next week, we're talking about, we're going to have a discussion about kind of secondary indicators and sources like charting and things like that that we can use as far as like when trade ideas come up. So we'll do that next week. We'll looking at different charts, maybe like FinViz and things like that to help you decipher between different types of trades. If we have multiples come up and things you may want to check. I'll go through things that I like to look at, and you guys can add in any other kind of things that you like to look at also. So I think it'll be a fruitful conversation next week. So but this week we'll get started here on market update. All right. So from last week, no change as far as the states on our indices are all still in two. So we'll go through each one of those. We did have, slight increase in, the green pie. I think it was like 38 or so, so about 4%. Nothing drastic. So let's take a look at market pulse. So overall state ones last week, we were pretty close to even. So, right there on Monday, we're about even. And then, so we've seen an increase as far as state ones, not really any kind of drop off in state eights. The market responded up, but it's kind of, even though we're slightly increasing, in the state ones, we're not, we've had a drop in the market there recently. So, as far as that, I still think, we're going to get across here in I would think in the near future. It's not very strong market at this point, but we'll have to wait and see on that. As far as like the new lows, we're still somewhat elevated. We didn't make any new highs as far as the new lows. The new highs definitely been lagging. You can let me sorry. You can see, we haven't really had much in the way of new highs, and since about a month here, pretty flat line there. The new lows are staying a little elevated, not dropping back to the flat line, like this is very bullish. We're seeing like 40 or something like that. We're still up in the 100, 200s, so but nothing drastic to say, market's rolling over as of yet. So, all right, we still got some people joining here. So that's overall bullish, bearish. I like to look for that 30% on the current states, like down here when it gets, that's usually a really good bullish sign, unless, the market's really, unless we're going to have some kind of huge move in the market, that's usually the bottom, when we're down in the 30 range. So we didn't really get down that low here, 34. We're still elevated, not overly bearish or bullish at this point. Nothing's really showing overall as, we got 30% in state one, so definitely not, overbought, and 12% above 30, so definitely not oversold. So we're in the chop range, and that just kind of goes back to everything's in state two when we're trying to figure out where things are going to go from here. So let's look at the modeling for SPX state two. It seems pretty range bound here so far. Tested the resistance up top, tested the support down here, and we're just been chopping back and forth here until we get an actual direction. That when we hit target 2, we did get a nice bounce up, but it didn't follow through. So that trade, if you do those trades, that should have worked, in a very short period, but we didn't get the follow through where it normally goes up to state 1 after that. So that's a little concerning overall for the market. So right now we're kind of in the middle. So I just see, as far as SPX, are we going to go down and test that, the critical level of target 3? So that's something to look for here and see if we can get out of this kind of range. Obviously we're 17 days in, trading days in, on an average 10, so definitely above average. You've hit targets, you've hit stop losses, and just kind of trying to figure out where this thing's going. So we had hoped we'd get resolution in those 10 trading days, but we're still waiting as far as that. So let's look at Russell. Russell's been a little better. So Russell's been a little better in state 2 than the other 2. So this is the entry price is providing strong support. So that's a key level you want to be watching, 2200 basically. If it can hold that, obviously will help with the bullish trends here. So that you can already see, it's been tested multiple times here. 1, 2, 3 times so far. So that would be the level I'm watching here. And then, up top, can it break through, these stop losses and get back into state 1? Obviously that'd be bullish. And if it breaks below the support, that'd be definitely concerning. Overall, when we talk about Russell, we've been talking about this for a long time. We've been range bound since February. We're still range bound. In this kind of 21 to 2350 tunnel here. So until we break out of that one way or the other, this this thing's just going sideways. It's been 8 months going sideways. So state 2 doesn't really tell us much. It's going sideways in state 2. So hopefully we'll start getting some market direction here in the near future. Nasdaq is pretty much the same as the SPX. So not much to discuss there. Pretty much a mirror of pretty close to a mirror of SPX. Same thing, we're above the average days. We've met the 2. Any trade you did for those that are very aggressive when it hit that, obviously you had a nice little return here. But like the SPX, no follow through, and we're back below, that entry level here. So that's a bearish sign that, typically when we get that target 2 or target 3 hit, we bounce up here and then, we get back up to state 1. That's typically what happens. So that we failed here, basically at the top of the entry price here. Not a good sign overall for the market, for SPX and for NDX. So I'd be watching, is it gonna get down to those targets again? I think near term is that, watching that Russell at that entry price. So also for SPX, we like to look at these charts. I apologize, they're both green, these SMAs. I tried to switch them, but this is the 50, and we know that it was broken and it basically turned into resistance. So what I also put in is the top one up there is the 20-day. So a lot of times when, not all the time, but a lot of.
Well, it's been a long time, isn't it?
Whoa.
I think you might want to. Yeah.
A lot of the times with the, when the market starts turning over, that 20-day SMA will act as pretty strong resistance. So that's something to keep an eye on here. Obviously, we see that the 50 turned into resistance here. Sorry, the annotations. So the 50, this turned into resistance, and it was support for a very long time, like about a year, maybe more. So, when it failed there, we were hoping it'd get back above and, act as support, but now it's turned into resistance here. So I just kind of watch that 20-day. It's not like a perfect indicator for those downturns, but it in the past, it's done a pretty good job most of the time of, if it can't get above that 20-day SMA over time, it keeps falling below it, then, bad things are coming. That's typically what happens. All right, so got some joiners. One other thing I want to point out, I don't go here much. I do personally. I don't like to advocate it, but they do a pretty good job. This is finbiz.com. I pulled up the SPY. They do a pretty good job, with these, like trend lines and things like that. So I noticed this, we're getting kind of on this trend line here for SPY. So that's just another thing to kind of look for. I've looked at a lot of different symbols, kind of like, the big ones, and a lot of them have broken below that, the bottom trend line. So it's not a good sign overall for the market that a lot of these kind of strong names are dropping below there. So just keep an eye on that as far as, SPY. Obviously, if that breaks below, it could get ugly. And, the same thing with Russell. If we can get below that channel range, then I think things will get real ugly. Overall, we're still just kind of seeing which way the market's gonna go. It's, if anything, I'm kind of leaning bearish at this point based off of how things are unfolding in the modeling and some of the other charts. So just what we've been talking since they got into state 2, kind of be careful, and we'll just have to see how this thing plays out. But overall, just kind of lean in a little bearish at this point, which is not a good sign. So I'll open it up to comments and questions.
Well, this is Dave, and of course, I always have some sort of a comment or opinion on what more or less and here's usually what I look at every week, and whether there's a difference between the week, and that's whatever I particularly might be looking at as major market risks, and where they may or may not have an impact on implied volatility looking forward. And that's the only reason I look at several of these things, is I'm trying to see if there's going to be an implied volatility change from week to week. So, from the last time, there's been some new news since our last week, right? We had the politicians kick the can for the debt ceiling down one more month, which kind of just got us past all the major earnings releases for this month, right? But it didn't really get out of the deal. It just postponed it, which basically just says, okay, we're not going to worry about it for a month. But in my opinion, that may raise the level of implied volatility the next time it comes up. Now, again, my personal view is I don't think we'll ever default on our debt, but until we raise it permanently or raise it, again, I think the next time around we'll have implied volatility kind of increase there. And the Fed jobs number came out last week, and it was kind of abysmal. We didn't create near as many new jobs as they were supposed to. So that really doesn't change the Fed outlook from the week before, or I don't expect that to change until the week after. Next week will be the same, I'm guessing, too, because we're in the same spot. The mandate for jobs is not being met yet. Inflation looks like it's kicking up to where the Fed would kind of like it to be above 0, but not, go to 10 or 20. So, that's there. The infrastructure bill still hasn't been passed, so that's a big amount of money that hasn't been, thrown into possible inflationary issues, but it's still hanging out there. The one issue that I think might warrant just a little bit more focus is the thing that Dan's brought up a couple of times, and that's supply chain impact. And I want to just mention a couple of things that were interesting, that I thought were interesting. Might affect other people's thoughts about things, but Apple just yesterday finally announced that, oh, by the way, I guess the supply chain thing is actually going to impact us, even though we have Apple probably has the most buying pressure power they can put on their suppliers, because they're the big user, right? But the question that I kind of think is, and by the way, all the Apple suppliers have taken a big kick in the teeth here. And I notice I follow the chip guys, so a lot of the chip guys have been hit because Apple has now come out and said, "Oh, supply chains, we're not going to sell 10 million iPhones as quickly as we thought," which is a pretty big number. But here's the thing that I question is, like, do the people that supply Apple and the OEM suppliers, aren't they not the ones that have pricing power? I mean, they're just not going to sell as many iPhones as fast, but they're not going to not make as many iPhones as they were going to make. So they're going to still require all the stuff that goes into the iPhones that they always had. They're just going to lose some of their pricing power as buyers that they have. And I think the suppliers to OEMs like that might have more buying lever or selling, a pricing power leverage going through, because the demand is still there. They're just it's pushed out a little bit. Anyway, so supply chain, I think, might be more of an impact on earnings, specific areas and groups, industry groups, and OEMs might be thought of as different than suppliers. So it just might be something to think about. Anyway, that's my uptake. I probably don't expect much difference between this week and what we're going to talk about next week, to tell you the truth. But the supply chain, I think, is the one that might be more important to the specific areas in the next couple of weeks, depending upon what companies you might be trading against. So anyway, that's my take on the risks to implied volatility for a week.
Yeah, well, I agree with your synopsis there, Dave. Supply chains have definitely been, I've read lots and lots of articles about issues with supply chains, and everyone knows about the ships all backed up in California. Like over in China, it's like 5 times as many ships. So there's definitely something going on in the supply chain, and that could definitely derail a lot of things. Products, for the holidays, and I don't think it shouldn't affect food too much, since that's mostly domestically, created and shipped. But like we've spoken about quite a bit, is where are these workers? Like there's like labor shortages everywhere. So I don't know where these people have gone, but truckers, sailors, all those guys. So not sure exactly. I can't explain, those supply chain issues, but I've read a lot of articles about it, and I think it's only going to, continue for foreseeable future here. Doesn't seem like there's solutions being rolled out yet. So as far as I've read. So thanks, Dave. Anyone else got questions or comments on that? No? All right. Well, we'll turn it over to Shawn then and get rolling on some of these earnings trades. You ready, Shawn?
Yep, ready to go. So yeah, there's a couple of just new trades that had come out for the earnings plans from last week, but I did want to kind of piggyback on what you guys were just talking about and ask Dave or anybody this question really. So since it's looking for the possibility of implied volatility to be increasing, is everybody then being somewhat cautious? Dave, are you looking to be a seller of options then, more so now than any other time? or just trying to be more cautious and see what happens with the markets?
Okay, I was going to wait for you to kind of give your presentation, but because I had a point just to bring up here. Okay, let's talk. Yes, there's been something that's affected my thinking a little bit, and let's talk about one particular trade, the vol crush trade, that we usually do before earnings. And one thing I looked at, the first group that comes out are banks, right? JP Morgan announced what, last night or tonight. Anyway, they're out. We're out today, and they're down somewhat. They didn't beat, so they're down. Now, one thing, that group, the banks group, is not the highest of beta kind of stocks in that group. And one thing, and this is something they're the first to report, so I'm not sure that the best bellwether for the entire S&P 500, the banks, but they are the first to report most of the big ones. Now, one thing that I thought about, and I did this trade not as a vol crush iron butterfly, but I was thinking to tweak a little bit for the low beta stocks. Kind of like I think of these as slow movers, into and through earnings, the couple of weeks before and after. And one thing I tweaked that might be worth thinking about in the future is, instead of the vol crush the day of, the day of the earnings, or the just before earnings come out, go like a week before, like I did JPM and Morgan Stanley. I did iron condors a week before, not the day, so I have like 10 days of theta involved instead of just 2 or 3. And I think it's an interesting trade concept to think about. So yes, selling, yes, to your bottom line, first question that you asked, I'm thinking about selling more. And so if I get, I'm selling, if you will, I'm not targeting, or I'm not looking at the specific where the stock is going to be, which is kind of where the iron butterfly goes. You're looking for the short strike. You're trying to hit the short strike. I'm now trying to stay out of the range of a week's worth of what the market maker move is for a week, which is a little bit different to find than the market maker move for the day, because you're looking at 10 or 12 days of moving there. But on these kind of stocks, I think it's easier to stay in the range for a whole week, and like I say, you have then 10 days of theta before you get to the earnings release, and then there's whatever the crush is after, even if it's muted. Now, I noticed that JP Morgan, I think the implied volatility was still about 10 percentage points different from a week ago than it is today. I looked at that trade, and it stayed within the range. If you did the vol crush at the day, I'm not sure how that trade worked out, but I didn't do that one, so it might be interesting to compare that one. But that's a little bit, so I think it might behoove us to be more sellers than not sellers at this go round. That was the question you asked right away. But that's why I looked at those things, that idea across a couple of the bank stocks beforehand, and I think it's might have some merit in the future. That's the answer to your question. That's a long answer to your question. Sorry about long-winded. I apologize.
No, I mean, I think in my opinion, that seems pretty fair, right? I mean, in past, the market definitely has been, or at least it seemed to take a big little swing, or a big swing down, and then followed by 3 big days up. So really the direction seemed to be a lot higher, whereas now it seems like we're getting, this choppy action or the sideways action in the market, where you get it 1 day up, 1 day down, and net it's pretty much flat. So possibly working a strategy like that, coming into earnings, if that implied volatility is high or getting higher, that might be an optimal, or that might be a good strategy to employ. I think if we could find those times in history when, the environments are similar, and then back test it within the platform, that would give us a good analysis to be able to look at it, or, even track it in the virtual portfolio now to see how, these would play out. It's not going to tell us what to do in the future, but it'll give us an idea of how to maybe be flexible in different trading environments, And the reason I mentioned that was because, I just wanted to let everybody know, there is, when you do have implied volatility low, a lot of people look at buying options at that particular time or buying, different strategies. And then when implied volatility is really high, then you're looking to be a seller of the options for that implied volatility to drop. And then, in theory, you can buy back those options, for a discounted price. So that's why I wanted to ask you that, Dave, because it seems like if you think implied volatility is going higher or is relatively high, then now, in my opinion, would be a time to possibly sell options. So.
Yeah, totally agree with that.
Anybody else? Oh yeah, go ahead, Joe.
Yeah, just with regards to selling options, if, so when you sell options, you go short gamma. And, in a increasing implied volatility climate, negative gamma is obviously more challenging to manage. So that's just something that you have to be aware of. If you're doing covered calls and, 100 shares versus one call, it's not a big deal. But, net selling options is going to give you that negative gamma and, maybe a little more challenging to manage the overall delta position with negative gamma in an increased volatility environment. That's just one thing. And then Dave, to your point, taking maybe a position 10 days in advance of the earnings, the wild card there, and I'm sure we could go back in and do some back testing, is will the expected increase in that implied volatility coming to the earnings date offset the decay of those 5 or 10 days? So I think that's the thing that has to be tested. Because in theory, the implieds tend to go up right to the point of the earnings announcement. So that's certainly something that we could take a look at.
Yeah, definitely something to check out. Yeah, I mean, it makes sense that you would have that implied volatility increasing up to earnings, since it is somewhat, well, in theory, it should be somewhat of an unknown for the majority of the people. So, yeah, and good point, Joe. I mean, I'm not by any means advocating, I don't want to speak for Dave, and I don't think Dave does this, but, I'm not advocating just being a straight naked seller of options, naked selling, calls or naked selling puts, just because of the risk. Obviously, selling calls naked, unlimited risk to the upside, selling puts naked, in theory, unlimited risk. I mean, the stock can only go to zero, which typically isn't going to happen, but you do have a decent amount of risk exposure on both sides if you're doing a trade like that, and not advocating that by any means, but just wanted to, be a seller of spreads maybe, or something to that effect. And that's what's beautiful about Delphian, right? Is just getting in there and testing it. And if you're not sure what that means, you can go in there and say, well, what happens if I just sell, straight naked calls, and then the stock goes up, and you can kind of see what impact that would have on your portfolio and see if that sits well in your stomach or not. I've had experience, being in those positions for my clients when we traded commodities, and, I couldn't sleep well at night. So I'm sure they were possibly having a similar reaction as well, and it wasn't even my money. So it's definitely not a strategy that I employ now. But yeah, so any other comments, guys? I just wanted to see, I know, we have the studies. This is kind of Josh's area, but Josh and I both, kind of put this stuff together. But with the studies, there's been a lot of trades that have been coming out under the high probability trades. And, if you are more cautious in this environment, because there are a lot of different external factors around the world happening, at the same time, that is making the market a little, uneasy. Is everyone being cautious, or does anyone want to speak of that? Are you being more cautious to not put any new trades on, or trying to figure out ways to hedge your positions, or looking at those high probability trades but not really trading them, just kind of tracking them? Anybody want to add any thoughts or input to that?
Yeah, Shawn, this is Winslow. I'll add some comments.
Yeah, Winslow.
I'm doing these bull puts. I liked, like a year ago or whatever, I did a bunch of long calls, but then I got sick of buying a call. So I think the bull put is much better. I've done these, you sort of have to have faith that it's going to go up and you're going to make some money. I've traded, I missed the first week, and then I started in on the 4th of October. and I've implemented 13 trades, one of which I've gotten my 25% profit, which was the Nasdaq NDAQ. So I picked up Apple, Starbucks, Intel, BX, Lincoln National, Qualcomm, Bird Gaming, Facebook, Six Flags, Google, because I've never done Google, so I did Google, Goldman Sachs, and FTNT. Anyway, I'm up on 4 of them right now and down on a bunch, but I still have 2 or 3 weeks to go. My question, well, I'm still frustrated that you can't get the confirmed earnings date soon enough. There were a couple of cases where I got the email, I clicked on it, you said estimated. I went to Schwab because that's my broker, and they had confirmed a couple of them by that morning. I think I took a couple.
Right.
But my real frustration is, and there's nothing you can do about it, I don't think. There's a bunch of stocks that have great volume, like Apple and Facebook and stuff. And then there's a bunch of stocks that are just like garbage for volume.
Right.
So like today, you get the email, and I was following AN and EXAS. I don't think I wanted that one. So AN, so I look at it at not 10:05 or whatever, and you can see someone in our group did one trade
Right.
of that one. And I'm looking at it and I say, oh, that's great. There's just like no volume. There's some open interest. So I think that's sort of, we'll see on those if I'm going to be able to get out at a decent price. But my real question is, I wanted to do, I started doing things myself. So I got irritated and I said, okay, when do I get the earnings confirmed? I get it confirmed. I look at Josh's spreadsheet to see if I'm still 100% or 90% return, winners in the last 10 times. And then I see if I can't have a decent trade of 1 or 2 contracts of a net $1,000 or $1,500, and if I can make 25 to 30%. So Google, I said, okay, damn it, I'm going to do Google. Now, I did Google. I did the 12.17, and then the increments are $50 increments. So I did 2,800 and 2750. And I collected, so my net, this 5,000, my net was 2850 risk. And I'm trying to make 1,075, so that's okay. Then I said, well, why do I have to do that? Why don't I just do the November 19th? And then I have more choices. So I did that on Goldman Sachs. So finally, Goldman Sachs, gets the earnings confirmed. I go into Josh's spreadsheet and wow, for 6 days or 5 days, I could do Goldman Sachs. So I go ahead and do Goldman Sachs. But I do it for November 19th because there's a little more volume and I'm not risking as much. So I don't know. I just hope I can get out of these at a decent price. I mean, right now I'm winning in 4. I'm probably going to get on BX. I'll probably get out tomorrow with that. I'm halfway there. And then the other ones are losers, but that's okay. I got 2 more weeks or 3 more weeks. So I don't know. It's just, that's my, what I wanted to do is see if I could make $5,000 every quarter. That would be good. That would be a great challenge.
Right.
So my total risk is 16,652, making 48.83 for a 29% gain. I'm not going to get that, but if we could get the earnings better, so it hits Josh's peaks, that would be great. Right. I don't know if we can, but and then the other thought is, well, I'm only going to do volume. I'm only going to do 10 stocks, and I'll just close my eyes and do it, even if it's estimated. So I don't know.
Right.
I'm betwixt and between, but I did it, and I'm not going to do any more. Because I don't think, oh yeah, Microsoft. I just did Microsoft. I mean, I didn't do it.
Right.
I finally got the damn thing confirmed, but then
Right.
you look at Josh's spreadsheet, and I was like, I'm not taking it. Darn it. So it's frustrating.
Yeah.
I have a fairly high level of frustration, but I'm willing to click the button and go. I go at the
Right.
midpoint. I go at the midpoint, limit credit, and just sit there. Sometimes you get it immediately, but usually it takes, I don't know, a half hour or so. So
Yeah.
that's for,
But
so I'm doing this, so that's it. Yeah.
yeah, and those are great points too, right? And I hear you on the frustration point, right? I think first and foremost, getting those earnings dates, confirmed or estimated is something we've been talking about, and something between Joe, Josh, and myself and Ashok, we're trying to get the best source so we can find this information, for us to use in a timely manner. Because you're right, on some, like Microsoft is a great example. We get our information from a third party Zacks, and Microsoft typically, I think we talked about it last week, the majority of the time that I've looked at it, Microsoft always, I don't know if this is right, but Microsoft, let's say, always reported on that third Thursday of the month, when their quarter was due to release. And that seemed to always be the case, but they always still have, it estimated, or I'm sorry, Zacks always has it estimated until a certain point in time. But I have noticed on other places like Schwab or other sources that we have where, they'll have a confirmed and we'll have estimated, or we'll have a confirmed and they'll have estimated. So what we're trying to do is we're just trying to say, okay, we have this conflicting information on both sides. So which side has the most accurate information? And if it's viable for us to make that change to give us that information, then we'll do it. And we're also trying to run or get our IT group to maybe run a screener. And what that screener will do, we'll say, okay, every time Microsoft has reported for the past 4 years, are they always on this same, schedule of a third Thursday of every month that they do that? And if it's, 9 out of 10 times they do, then like you said, I think you could get into a trade like that, even though it's estimated, and just have a little more confidence on, okay, that seems fair, right? Because like you say, I mean, Microsoft or Apple, I mean, those are great trades that I feel that you want to be in, coming into earnings.
Yeah, I'm in
Say
Apple.
again?
I'm in Apple, and I've got 4% profit. My best idea, though, a little tongue in cheek, was to contact Sadir and pay him to do it for me.
Right. Yeah, no doubt. He does a great job, and he's been a customer, and he's been a colleague of ours for a long time now. We had, he was part of or is part of a Dallas meetup group. So anytime we would go to Dallas, he would always be there at the meetings, in person, and he would always have lunch with us. And he's not on the call today. He said he had a conflict, but been always a great person to give good advice and take our advice, and not advice per se, but give good ideas and take our ideas and things like that. So collaborating with him, between me and him, or between you and him, I think is a great idea. And I think, based on everything I've heard from him, he'd be willing to talk to you and kind of go over that. So I mean, tongue in cheek, but I think it's true, right? So
yeah, and I mean, I'd be willing to just click a button that says or open a Tradier or a Tradier account.
Right. And but yeah, the earnings, those confirm, we're working on that, and I agree with you completely, because I see ones like Microsoft come across, and I trade these too live. I see ones like Microsoft come across, and if it's estimated, I'm like, man, I really want to do this trade. So then I'll do like you did with Schwab or other sources. I'll just go out there and just say, all right, well, how often do they report on the same day? I'll just kind of run through my personal checklist, and then and then I'm like, okay, well, it's estimated, but I'm going to do it right. I can't put that trade out to you guys in the way of Delphian, because when it back tests for the data that we have within Delphian, it doesn't say it's confirmed. I don't want to give you conflicting information and then say, well, this is maybe what I would do. And I just feel that if I do that, then, I'm putting the onus a little bit on myself, and, just for legal reasons and whatnot, might not be the best thing. So I have to be kind of careful. But, you know, on the volume and the open interest part, you know, here I have that Google up, I have those November options, you know. On the Google trade, you're right. I think, you know, when we run the stock list for these earnings trades or for the high probability trades, you know, we're running it off of a stock list that is somewhat static. So, you know, if we run the back test, you know, 6 months ago, you know, the options volume or the open interest for those particular options or for that particular stock could change dramatically over the course of time. You know, so it's always prudent, I think, to come in here or use an option chain just to verify, you know, the volume and the open interest of those options that you're getting in. Because you're right, I've seen some, not necessarily the AN symbol, but I've seen others where, you know, I look at the recommended, you know, trade and there's 1 or 2 options traded. And just like you said, I'm like, okay, I know somebody sit here, somebody in the group's probably traded this, right? And they're probably the only person in there.
Right.
And you have to be careful, because you're right. If you're up money on that trade and it's only you and another person or whomever, if somebody doesn't want to take the other side of that trade, well, you know, you're kind of out of luck at that point, right? Like, sorry about your luck. You could be up, you know, 1,000%, but if nobody's willing to buy it from you or, you know, do the opposite transaction, then it doesn't matter how much money you're up, they don't want to pay for it. And I think it's just like your house or something, right? If you're trying to sell your house, you might think it's worth $1 million, but if there's only a guy out there that's willing just to pay $100,000 for it, well, you know, what are you going to do, right? It doesn't matter what you want to pay, what you think it's worth. It's what somebody's willing to pay for it. So it's tough, but yeah, that volume and open interest is huge. And I would definitely, you know, every time before I put the trade on, I just take a quick glance at it to see. And if it's too low, then I have to really evaluate, you know, what's going on, you know, and we can't control that because it could change. You know, we run these tests, like I said, you know, a month ago, so it could easily kind of detract from that by the time the trade comes about.
Hey, Shawn?
Yeah, Joe.
Just real quick with regards to the volume and open interest, I think everybody probably knows each underlying has a dominant cycle. So, you know, every 4 quarters is their dominant monthly. So sometimes you will see, you know, more volume and open interest in that just because, you know, that's probably been, you know, the active option for a longer time. And, you know, we've added far more options, and our liquid lists, which we continue to review, you know, a number of them have weeklies. So, you know, from month to month, there really can be a lot of variability, but more often than not, those dominant cycle months are the ones with more volume and open interest.
Yeah, good point. And yeah, and that's the same with futures, right? Futures have certain monthly cycles, and like Joe said, I mean, your options are going to have similar cycles as well. So you might pull up an option that, you know, has no open interest or very limited open interest, very limited option, and then go back 30 days or go forward 30 days and see a completely different picture. So, you know, it's always, you know, prudent to kind of check that information. And I think to your point too, you know, when I'm looking at the earnings trades or the high probability trades, and, you know, here, you know, this option in November is 38 days to expiration, but I've seen some with the earnings or high probability that, you know, it might be 55 days to expiration. And because we set up those rules when we do that trading strategy that has to be at least 60 days on the options, it's not going to look at the options that have that 55 days until expiration. So, you know, if I think, you know, going out to January or going out to February of next year is a little too far, and then the next cycle available, you know, the closer cycle that I have available is 55 days or 50 days, you know, I'll look at that option. I'll look at the availability like you did for the November, but I'll also try to run a back test on it. I'll run the back test on it to say, you know, what if I do this strategy with an option that's 40 to 60 days of expiration on it, and see how many, you know, back test results I get from that. And if the results are pretty similar to what Josh or I have shown on our sheets, then, you know, it could be a viable trade to use that particular option strike or use that particular option expiration. But, you know, I don't want to do it without testing it, because I feel, you know, we have access to the platform. It gives us some pretty good insight. So I'm going to use it. If I can't back test it, then I'll just stick with, you know, the rules that are set in the platform that we've pushed out there. But if I do have the ability to back test it, I'll say, all right, well, what would happen if I did this trade? And it could work out better. It could work out worse. I don't know until I actually look at those results. So that's another little piece. It's hard to do if you see the trade come out on, you know, Tuesday morning and you want to put it on Tuesday. It kind of puts a little fire in you to try to maybe, you know, do it a little faster, and then you might make some errors. But if you do have a couple of days to kind of run that analysis, I think it gives you the benefit to do it if you can run some of those tests. And if you don't know how to do it, obviously feel free to contact myself or Josh, and we can help you out.
Shawn,
But cool. Yes.
hi, it's Jean.
Hey, Gene.
Hi. I was just curious because I've been in and out of the class quite a bit and haven't been applying myself to some of these trades, but I did do a couple, and one of them that I think it was Winslow that mentioned EXAS.
Mm-hmm.
That was a bull put.
Yeah.
And I thought that the volume was sufficient and the open interest was sufficient, but the bid-ask spread was certainly wide. But I went ahead and put it on for the $5.63 credit that I got on that bull put. And so far it's okay. But my question is, when you do a bull put spread and you're using like 100 days out, that was a January 21st expiration date, you know that you're not going to ever reach, or well, let me say this, it seems like you're not going to ever reach until that last couple of weeks a profit, because even if like it's up at 98 right now and my short was at 95, and it was at 97 when I put it on, so it's going up, but it's going to take a while before it's still showing that you know, I'm at a loss. My thing is, why do we have such a long expiration date on bull put spreads? Because even up to the last week, a lot of times you don't get where it shows that you can make a profit. Do you know what I mean? Am I saying that right?
Yeah, you're saying it right. Yeah, and I mean, we run it at, I think the bull put, and Josh can correct me if I'm wrong, is at 60 days minimum. So yeah, if there's options that are, like Joe mentioned, right, if there's some options that are expiring maybe 40 days, but then the next cycle doesn't do until 100 days, then you're either going to take the 40, which isn't going to be part of the back test, or then you're going to go all the way out to 100. And that's what you're seeing here for these January options for EXAS. 101 days as of last night's close, right?
Right.
But the next available, they do have weekly options here, so you could test a little bit further if you wanted to do that. I don't know what the weekly options, the volumes are, but if I go from January to November, I went from 101 to 38 days, a substantial, difference there in days on trade. Now, I mentioned it before, and it's kind of surprising. It was really surprising to me, to the fact that some of these bull put spreads that we're doing, and even though we're going out to January, if you get a decent move in this particular stock to the upside, then the options or the spreads are moving enough to make that 25% profit of that credit that you're looking to receive, which I found interesting, because I had a similar thinking as you. Is I thought that if I did this 100 days out, that I was gonna have to hold this trade probably to 80, I was gonna have to hold this trade for 80 days to even try to make a decent profit. So I was always just shying away from them. But on the back test and even some of the live trading I've been doing, it doesn't necessarily seem to be the case. Every stock is going to be different depending on the options. And even looking at this option chain real quick, I can see some of these values are, look like they're somewhat inaccurate, right? Because you can see this 82.50 is showing a mid price of 410 versus this 80, a mid price of 425. So there's no way my $80 put should be worth more than my 82.50 put, right? So I see a little bit of a discrepancy there, and you might see that, if this volume doesn't move for weeks, then they might not adjust that mid price of that option, whereas these other ones might be changing.
I guess my thing is, I don't like to do bull puts that far out, but I decided to try this one. But I can see I'm going to have to wait on it probably quite a while in order to really keep my credit. But I did want to try it and see, but I still like shorter term bull put spreads for myself. But so I would have to go in and retest the numbers that if I wanted to change it, right? I'd have to do a retest of that thing.
Yeah, and I can show you how to do that. We can set up a time next week or some other time to do that, because the other cool thing that I was going to tell you is there is an interesting way of running some analysis on the options. You just look at it. This one is a little bit sketchy. I can't really do it on this one, but I can show you a quick and easy way of how to, look at, how much does my stock need to move in value? How much does the stock price need to move to replicate a certain value in my put spread? And I can show you how to do that. But this one, I don't think we could do it on this one, because even look at this option here, 67.50 is worth $1.43, and the 65 put is almost double that at 275. So not accurate. Now you can see the difference is maybe those 2.5. So this 2.5 is 80. This one is 253. So this isn't a good option chain to show you an example on like that. But yeah, let's set up a time and we can kind of go over some stuff, because I would do that too. I don't like going this far out. So I might look at these November options and say, oh, 38 days. All right, well, how does that backtest if I try that? That might be a little too close.
Okay.
Not as much wiggle room. So.
Well, on a good note, I did try one of the what is that? RL, that's Ralph Lauren. I think that was a long call, because I don't usually do long calls, but I did try that one, and that one's working out. I'm almost at my 25% in 2 days. So that was a good example of, and I had not tried the long calls before. So, because I'm kind of like some of the other guys, I don't want to spend that much money, but that one only cost, I think it was $410 or something. And I just did one contract, but I think that one will close tomorrow, the next day. So 25%. So I was happy with that. So it's interesting. Yeah.
Hey, Jean.
Yes.
Just a question about the Ralph Lauren. So you put that on a couple days ago. I guess the stock ran pretty aggressively to the upside. Is that right?
I haven't looked at it right now, Joe. I'm just saying, oh, wait a minute. I did look at it this morning. Where is it?
Pull it up.
You pull it up. Yeah, you pull it up, because I'm trying.
It's going to be state modeling. So it's going to be a day, it's going to be last night's close, but I can pull it up on a different screen if I have to as well for today.
All these trades,
Go ahead, Joe.
Is that that was the green candle, right, for today?
For yesterday.
For yesterday?
Yeah. So just, the point, whether it's the long call or the bull put, the key aspect is the delta of the trade. These are not, if you're long call, there's more of a volatility exposure, but they truly are delta trades. And the reason we kind of reverted back to the bull put is because if you don't get the move to the upside as you anticipate with the long call position, you're giving up that theta. If you just get a stagnant, RL or one of your other positions, and you're short that put spread, that time value actually is what works for you by being short, close to the at the money option. But the bottom line for most of these trades, certainly the long call and the short bull put, is that they're delta trades. So you're just looking for that stock to go up, and whether you've got a November bull put or a January or February bull put, if the stock goes up quickly, you're going to get your profit targets.
Right. Well, yeah, I like the long expiration for buying a long call, don't you? I mean, so that theta doesn't work against you. So that one makes sense to me. Let me see if I can find my trade here.
Go ahead. Sorry, Jean. I'll comment to you, but I want to let you finish.
No, that's okay, Dave. Go ahead. I'm looking for I've got, everything's disorganized here. Sorry.
I was just going to comment that the bull put is, works. It's a different kind of trade, whether it's an earnings trade or whether it's outside of the earnings, expiration date, right? So, when it's a earnings play, if you don't get the move right at earnings, you're gonna end up waiting a long time to get paid off to make your money otherwise. So that's one point I wanted to make. Joe could probably comment on that too. The other thing I wanted to say about the bull put versus the long call is that you just made the point that if you get a sharp move, whether it's before earnings, during earnings, you kind of want it to be before earnings on the long call, even though you have it 6 days out, because you're paying a lot for it if you put it on just before earnings. So you want to take advantage of the implied volatility up to earnings, and then you're going to get hit after earnings on the long call if you hold it through earnings, right? So
right. I understand that. This was the earnings date on Ralph Lauren was November 2nd. So in the sheet that Delphian put out, that was the trade to use the January 22nd expiration date. And then let's see, it was at 114, I think, and now it's at 116. So that's why I said that one, what are you calling those? You're calling those your pre-earning.
The bullish pre-runners.
Pre-runners, yeah, your pre-runners. Because I have not done one of those. So I was just experimenting with that. And I thought this one looks like it's going to turn out good, hopefully. But the bull put, yeah, that was my thing. Because since I don't ever usually do real long bull put spreads, I do short ones, that I could see that would take a long time to probably have this one pay off for me, even though I have the credit, but it's still trading it. I would have to pay them to get out of it right now. You know what I'm saying? I'm not going to keep my money if I close any time this month. I don't think.
Yeah, here's a question I wanted to ask on that the very same subject to Joe and the Delphian guys there, and I was wondering if there's a relationship between the width of the spread. We're talking about bull put specifically here. On the bull put, the width of the spread compared to the price of the stock. If there's if that ratio is big, I wonder if I'm guessing that probably has a significant potential impact on the amount of time for payback. If it's a thin spread and it's a low price stock, I think you're gonna have to wait longer. But if the percentage of the difference between the width of the spread and the price of the stock, I think that might have an impact on how quickly you might get paid back when there's say any kind of a significant move in the stock. That was a question.
I see what you're saying, because this one was a wide spread. This was a short 95 and a long 77.50. So what is that? $17 or something width. So to make $5.63 credit. So then your risk is, what is that, 12 something?
Yeah, about 1,200, yeah.
So anyway, but that's a good point, Dave. You're saying if it's really wide, it might take longer.
I'm thinking another way. I'm thinking if it's really wide and there's a move, you're going to see the payback on the move. Maybe not, but that's what I was thinking, that the ones that you have to really wait a long time for is when the price of the stock's not all that high and it's not that wide of a width of the spreads. Right.
Okay. Yeah, I don't usually do that big a width either. So this was kind of an experiment for me on that kind of a bull put. And then the long call is something I just hadn't done before. So those were my experiments. One's really turning out good. The other one I do have questions about, and that's what we talked about. So, but thank you.
Yeah.
I'll give you a call, Shawn.
Yeah, no problem. And then, Joe might be able to speak more to the width of the spreads versus.
Okay.
How much,
or Joe. Yeah.
Can be. That's what I meant, Joe. I'm sorry. I might have said that. But I feel that way too. I think if the spread is really narrow or tight, it seems like it doesn't move as fast. But I think that might be more relative to how close those deltas are as well. If you look at your spread that's really close here, your deltas are some of these deltas are pretty close in value. But maybe if the spread's a bit wider, or like a Google or an Amazon, those deltas might be substantially different. So that's what first came to my mind. But
well, definitely I have to work on the spreadsheet because that part's really not working for me. I don't have enough columns in there stating certain things that I need to be able to look at.
But too, and what we can talk about too is that's where I think that virtual portfolio can come into a huge help for you, Gene, is, you know, taking some of those trades, and if you're a little worried, you know, a little concerned about going that far out for those spreads or wherever the case may be, just throw them in that virtual portfolio. And sometimes what I do is if there's two trades and I want to compare them, I'll just throw them in the same portfolio together, you know, as long as the trades aren't conflicting, so it doesn't mess anything, like I'm not opening one and closing one at the same time. But what I might do is I'll say, let me put the bull put for Ralph Lauren in a portfolio, and then I'll put that long call in that same portfolio. Typically they'll be sitting there next to each other, and then I can view it, you know, day to day of how those positions are changing and how the values are changing. And I think that might give you some good ideas of, you know, make you a little more comfortable trading some of those options or some of those bull put spreads that they do have further out time value on them. So
Okay, great. Thank you.
oh, no worries. So yeah, so Joe, any thoughts on that, Joe, regarding what Dave was mentioning, the spreads, like a wider spread versus a more narrow spread, and taking a longer time to make a profit on a credit trade like that?
Yeah, no, I think you hit on it really with regards to the delta of the spread being, you know, the thing that I track most closely. And, you know, with regard to the distance between the strikes and time and the price of the underlying, you know, it makes sense, but I'd never really looked at it that way. I just kind of track the delta of the spread itself.
Yeah. Okay. Yeah, cool. Fair enough. So yeah, that good discussion, guys. I think that's really all I had. I mean, we'd had a couple of new trades come about over the past week, 6 new trades that were confirmed that went into the virtual portfolio, and I'm still tracking them. You know, I can kind of briefly show you guys what I'm looking at within the virtual. But great discussion. I appreciate you guys opening up and everybody talking to the positions and things like that. You know, but what I'm looking at for the virtual portfolios and for some of the other trades that we've been tracking here, we're down, you know, a decent percentage on this bull put spreads that we're tracking. But some of the big major ones that we talked about last week, you know, Shopify was one that I put in there with a huge amount of risk on the trade. And then, you know, like we showed last week, there's some other ones here. Chipotle was another one that has a decent amount of risk on the trade as well. So really, I think in a normal circumstance for someone that's trying to, you know, consistently make money, you know, trading these strategies or trading the earnings or using these strategies to make a profit, I really need to segregate and take some of these trades and put them in maybe their own portfolio, and then I can merge them together. But, you know, I'm not going to trade Shopify with that amount of risk on there. And, you know, I'm probably not going to trade Chipotle with that same amount of risk on there as well. They just don't match up with the majority of my portfolio. And as you can see, you know, $3,400 loss on Chipotle, a $2,000 loss currently on Shopify, you know, that's, you know, $5,500 or so. And that's pretty much taken me to where I would be net positive if, you know, those 2 trades went in my account and they don't match my risk profile anyway. So just something to think about, you know, to look at when you're doing these trades. You know, is that risk profile a little too much for you? And if it is, that's perfectly fine. If we can adjust the strategy a little bit, maybe, you know, making that spread a little more narrow, that might help out. But if it doesn't backtest properly when you do that, then the trade, I would say, is just not a go, right? That's a trade that we want to bypass on. So, you know, just wanted to show you guys that 6 new trades confirmed versus, I think we had 14 that were total. So like 7 or so that were estimated. And back to Winslow's point, you know, we're trying to get these things confirmed, and we're trying to see if there's a way that we can, you know, give us some better, you know, upfront knowledge of these trades and these earnings trades as they come out. But, you know, that's yet to be seen. But once we come up with some conclusive answer, you know, we'll let you guys know. And if we can make the change, we'll do that. We're always looking to change stuff for the better. So we're working on it. But yeah, well, thanks guys again for giving your inputs. That's all I had. So I appreciate you guys listening to me, and back to you, Josh.
All right, thanks, Shawn. Very spirited discussion there, and we can continue it next week. So thank you all for attending, and we'll see you next week.
Thanks, Josh and Shawn.
Yeah, thanks, guys.